Hello and welcome to this month's Financial Markets Update. Well, the financial ended off on a pretty strong note. Through the month of June, we actually saw some really strong investment performance come across a number of asset classes over the course of the month. Predominantly equities really delivered some very strong results. We saw our local equity market up roughly around about 1.8% over the course of the month. But the real drivers of performance actually came from global markets, with both large cap and small to mid cap stocks up strongly. The SMID Global Index was up over 6% over the course of the month, while we saw global equities, particularly on a hedge basis, up over 5% over the course of the month. So it really ended a really strong first half year performance right across the board. The only weakness that we saw over the course of the month was in Aussie bonds. We saw bond yields actually move higher right across the curve throughout the course of the month, and this is on the back of the RBA pushing rates up by a further 0.25% to 4.1%, and this resulted in a pretty significant sell-off in bond markets, just given the view that cash rates locally are still likely to move higher. We've seen the RBA probably behind the curve when you think about it relative to other central banks around the world. So that bond market sell-off actually resulted in our local bond market down just under 2% over the course of the month. Global bonds were by and large flat. So we did see some really solid performance. REIT markets were also higher over the course of the month, particularly global REITs. We actually saw our local REIT market flat. And as I said, we saw some very strong performance in the Aussie dollar, which was up a tick over 2% over the course of the month. So we look at the performance of investment markets over the last 12 months. You can see from this chart here that by and large it's been a very strong market performance, despite clearly the numerous challenges that are facing global markets, principally led by higher inflationary pressures coming through the system, and obviously a significant increase in cash rates from central banks right around the world. So that impact flowing through into the broader economy has certainly resulted in some sluggishness in the global economy, but we haven't necessarily seen that translate directly into the performance of financial markets. And as you can see from this chart here, if looking at the performance, particularly of growth assets, namely equities, over the last 12-month period, they've all delivered very solid, strong investment returns. The only market that we've seen weaker over the course of the last 12 months has been in G-REITs, principally two elements associated with that. One, obviously, the weakness in the Australian dollar, and the exposure to G-REITs by and large is through $8 hedging. And then equally, the weakness that we've seen in the property markets, particularly in the commercial space and also parts of the retail market, has obviously seen cap rates move out, and that's obviously resulted in a decline in property market values. Notwithstanding that, as we sit here today and we think about the market opportunities going forward, we think that once we do start to see cash rates peak, the opportunity, just given the decline in valuations that we've seen across the property market, we do believe there is some potential for some upside coming through in that part of the market through the second half of this year. But certainly, as I said, at this stage, it's obviously still quite constrained, given one, obviously the valuations that we're seeing right across the board, and certainly from our perspective, central banks have yet to finalise their cash rate policies and the tightening of their cash rates. But we do expect that to occur through the second half of this year. And interestingly, when we look at the performance of financial markets, and I think this is one of the interesting notes to think about in the context of setting strategy, because it's clear from our perspective that market performance has been a little stronger than what we would have anticipated going into the course of 2023, certainly off the back of what was a very challenging 2022 in terms of market performance. But just looking at this chart here in regards to the performance of the ASX sectors, comparing the calendar year 2022 to what we've seen through the first half of 2023. And you can see here that the sectors that clearly underperformed, and there was a significant amount of those in 2022, IT sector was actually the worst performing sector, has rebounded the strongest throughout the first half of this year. And other sectors such as energy, which obviously we saw some significant increases in energy prices, particularly oil and gas as an example. Those prices have moderated through the first half of this year, and unsurprisingly, we've seen the energy sector pull back. The Aussie market throughout all of that, relatively flat through the course of 2022, but we've seen the market up roughly around about 4.5% through the first half of this calendar year. So all in all, from our perspective, we actually see some really quite positive signs in the context of financial market performance. Certainly with bond yields moving higher, that's making it a little more attractive in the way that we think about fixed income exposures. And as I said, equity markets, if we do avoid, which is our base case, we are likely to avoid a significant slowdown in both the domestic as well as global economy. We think that will be positive for growth assets as we move through the second half of this year into 2024, and the potential for central banks to actually cut cash rates at some stage through the second half of 2024, we think will be positive for growth assets. So a really interesting environment for financial markets. As I said, June was a solid period for financial markets and a really good way to end the financial year. And certainly when we look at the performance of financial markets over the last 12 months, the doom and gloom that we're seeing in regards to the backdrop of the global economy and some of the implications facing that, along with high inflation, higher cash rates and the like, slowing consumer demand, as I said, doesn't and hasn't translated directly into financial market performance. And again, I think it's another good adage as to why diversity and having a spread of investments from an asset allocation point of view can make a lot of sense when delivering investment performance through the cycle. As always, if you have any queries or concerns about your portfolios, please feel free to reach out to anyone in the team, and we'll catch up again next month. Thanks and bye for now.